G'day guys, welcome back. In this video, I am going to talk about some of my opinions with the stock market crash, especially for ASX investor. This video is a reply to CD for asking my opinion about a stock market bubble and black swan crisis. In the past 50 years, there are a lot of world events that affected the stock market bubble that resulted in the stock market crash, such as global financial crisis in 2007. Because it's such a broad topic, I'm just gonna talk about 4 points in this video. First, I'm gonna talk about basic facts of a stock market bubble with an example with what happened with Australian real estate investment trusts in the global financial crisis era. Next, I'm gonna talk about briefly about relationship between bond interest rate and the stock market valuation. Next, I'm gonna talk about the positive impact of the stock market crash. Lastly, I'm gonna wrap it up with the common mistakes in investing during and after stock market crash. Without further ado, let's get into it. So what is a stock market bubble? Stock market bubble can happen with many factors, but generally it involves overvaluation of the stock, that people paying too much for an asset. It can be anything. It could be value of property or even cryptocurrency or even a company shares where the valuation doesn't make sense anymore. Next, it involves some signs of euphoria and a broad optimism in a particular asset, even if those people doesn't have any understanding with that particular asset. And lastly, usually stock market bubble involves using high leverage, imprudent use of debt, which what happened with the subprime mortgage crisis, also called GFC, in 2007. Let's have a look at the Charter Hall Group with the ticker code CHC. And this is true with most of the Australian real estate investment trusts, where it took them 12 years to justify the valuation they have in the period of 2006 and 2008. As you can see here, around June 2006, CHC share price was priced about $5 and it doubles to almost about $13 in around 2007. And after the GFC happens in America, most of Australian REIT companies drop in value by at least 90%. And if you see the PE ratio of 2007 is over 100 based on the earning of 2007. This is the chart I have. See the blue is the market capitalization, and the yellow line is the net asset, and the red line is the net profit after tax. You can see as the gap goes out of nowhere, valuation just doesn't make sense. Charter Hall Group, in terms of debt to equity ratio in the period of 2006 and 2008, reached a really high debt to equity ratio to the level that is over 40 or even reach the level over 60%. They themselves, as a REIT company, used aggressive borrowing. But after that, the good thing happens that CHC become more careful with how they manage their debt. They try to keep it below 30%. Therefore, now they can justify their market capitalization. Aside with the stock market crash, a mini crash where each share price can drop over 30% can happen as well. Because, for example, the recent one is GameStop. How a particular group of people, kind of along with the hedge fund industry, resulted with the crazy increase and crazy drop in price of the GameStop. But the business itself is not doing so well. You start seeing that the safest way to be is to understand the business. So understand what you're paying for, why you pay this amount of dollar per share, and what are you gonna get in return. And usually, if your motivation is to get more from other people, where the business itself cannot produce good return on equity, it usually yields a bad result. Or even this police officer, I don't know, her name is Mia Khalifa, who said buy Nokia in her Twitter account on 27th January 2021. And as you can see, the price of Nokia increased by about 27% just from the tweet from a police officer. And after that, the price crashed, 26% getting wiped out, because people realize that people rather use iPhone and Samsung than the old Nokia that can break somebody's head. I think we need to learn from Peter Lynch, who wrote the book One Up on Wall Street. It's a good book. I highly recommend it if you have a spare time, or if you're not interested in reading, you can watch his interviews in the 90s. He's a successful hedge fund manager, a similar approach with Warren Buffett. And Peter Lynch is pretty much saying, know what you own. All you need to know about stock market crash is that stock market's gonna go down. And in his speech in the 90s, with the history of US stock market of 93 years, there are 50 declines with 10% or more. And most of the people will call it correction. 15 out of those 50 declines are stock market crash. That is, with 20% or more decline in the value. That means this is only specific with the US market. I'll explain to you why after. Every 2 years, US stock market most likely gonna decline by 10%. And every 6 years, US stock market's gonna decline 20%. So you have to get used to the fact that this free market capitalism system also has a weakness. That is, when people start become irrational in valuating the asset, then it can harm a lot of people, especially when it involves a lot of debt. And US and the ASX quite similarly track one another. It's quite similar in some ways. From the period of 2007 and 2021, about 14 years, in ASX we have 5 declines over 10%. That is one every 3 years, whereas US have every 2 years. And we have 2 crashes, the GFC and the COVID pandemic, for the past 14 years. So that's one every 7 years. So for the past 14 years, we have behaved quite similarly. Also noted our big market cap companies, if they not doing so well. For example, BHP has recorded their biggest loss in the amount of billions. I think it's over $5 or $6 billion loss in 2016. It will affect the ASX as well. But it could also be Brexit. And as you can see, there's many factors that can affect a stock market as overall. But the safest place to be is to understand that if your business metrics is doing well, there's nothing will happen to you as long as you're not selling it when the price is crashing. And it's very different with another stock market. For example, in Japan, they have Nikkei 225. It is the top 225 companies, similar to ASX 200 that we have in Australian Securities Exchange. And the index performed very differently to the US because the economy itself is stagnant and the corporate culture is different. So over 30 years, from 1991 to 2021, there are 5 declines over 10%. That is one every 6 years. And they have 6 crashes, a decline over 20%, one every 5 years. There is a lot of stock market crash in 30 years. And this is why when I see fund managers saying that, well, we do Asian global equities and they have expertise and so on and so on, and I never once heard them really have some understanding of the business, I always doubt their expertise in the Asian, because even in Japan, you know that the economy is stagnant, and even them have been trying with many macroeconomic magic, and still it's very hard for them to improve as what Australian can do right now. My opinion is that don't waste time on people who claim that they can predict a stock market crash. I saw this article from University of Sydney, one of the academic staff, saying that they know how to predict a stock market bubble in real time. And like I said, what kind of fortune teller is this? Where they have been trained in the modern financial education. And they say a new method for identifying financial bubble could help policymakers avert catastrophes like burst of 2007 housing bubble. I don't think it's very wise. I think it's a waste of time. And make sure you watch my recent video about Regal Investment too, where a portfolio manager is banned from giving financial advice, and he's probably a master in finance and so on, and yet he has a really bad business practice in terms of share trading. Briefly, I'm gonna mention that there is relationship somewhat with the bond interest rate and the share market valuation, because it's all about opportunity cost. And it's true most of the time, not always. And usually lower interest rate from the bonds usually means the share market valuation will be higher, because people will seek more return from another type of asset. And I like to show you these bonds and notes that NZ Bank issued in 1991 and 1990, where they have a bond that they issue for the interest as high as 16%. Imagine that, 16%. What would you rather? I would certainly would rather invest in bonds, because the banks will pay the senior bonds first, and then the least thing that they want to worry about is the dividend for the ordinary shares. And despite the horrifying effect of stock market crash, there are positive impacts. For example, in 1929, the US stock market crash that led to one of the greatest recession in American history is that it leads to better regulation on margin lending. Out of that stock market crash, the greatest investor of all time was born. In 2000 dot-com bubble teaches a lot of people to invest in the business you understand. It doesn't mean that a hot team, for example, .com or tech stock, will make you rich out of nowhere, and maybe just stick with normal Nasdaq 100 index if you want to invest in a tech company. It's less risky and less volatile than particular hot team ETF. So every crash, it teaches a lot of investor. I believe there will be another crash happening in the future. I don't know what's the reason, but it will teach us a great lesson every single time. And if we're focusing in studying and learning the business, how it is impacted from the stock market crash or without the stock market crash, we will be a better investor. The common mistake a lot of people make during and after stock market crash is that buying dips without understanding the business. And I've seen a lot of people are celebrating. I have done more than 30% return in the early 2021. They bought it after the crash in 2020, maybe around May or June, and they make 30% at least in 2020. And then they believe they can do it again next year and the next. Just keep buying dips without understanding what's going to happen to the business. That is a very dangerous approach. And what's the recent one now in September 2021? They're talking about the Chinese Evergrande that owns a lot of debt that they cannot pay back to the investor. And I know some people are buying dips, hoping that they'll make a lot of money. The Australian example will be GEM, the G8 Education, where in from 2010 to 2014, it's great. The share price just rose very quickly from maybe $1 to $5 in a matter of 4 years. And after 2015 till 2021, it has suffered by many factors. But one of the biggest factors is that they were involved in a scandal where they mispay. They didn't pay their workers properly for years, and they owe back every single of those education workers. So in conclusion, stock market is an auction-driven market. It's a great system. It's a free market capitalism that works well for the intelligent investor who understand the business, and not so well for the speculator and the gamblers, because nobody knows where the stock market gonna be in the future. And don't waste your time predicting a crash, or even don't waste the time talking with someone who thinks they know how to predict a crash. And media and stockbrokers will always do what they do best. They try to promote more transaction, because that's how they make the income. And I keep repeating myself, the best strategy is to focus on the business that you own, with good economic characteristics and good management. You obviously don't want to hire crooks and criminals running your company. And lastly, just as Charlie Munger has said, opportunity comes to the prepared mind. That is, spend your time starting a business obsessively and buy when the price is right. And there is no hurry at all. Thank you so much for watching, and I'll see you in the next video.